Looks like me and the rest of the bears were right a couple weeks ago when we said that the S&P was not going to be able to break convincingly above 2,800. We hit 2,800 just recently, and we've been bouncing off the ceiling. So the 2,800 resistance level is very much intact, and it looks like now, as of the last couple days, that not only are we bouncing off resistance, but we're going to head back down now. Because now that the market's retested that resistance zone, it's pretty clear that things can't go up, and if they can't go up, well, then they're probably going to go down. So everybody's selling. Now, so far, there hasn't been any panic. It's a pretty orderly withdrawal. As of the recording of this, futures are at for the S&P are at 2766, so still pretty close to 2,800, but we're heading down. And this is why the folks at the Fed are really freaking out now, because, you know, as they always like to say, they're very interested in their dual mandate. Now, some of you may know may think the Fed's dual mandate is maintaining low inflation and low unemployment, but in fact, the Fed's real dual mandate is S&P 3000 and Dow 30,000, to borrow a line from Zero Hedge. So because the Fed didn't have a plan for what would happen if stocks were unable to break above 2,800, which, you know, we've been on ever since the Christmas Eve massacre. Stocks have gone straight up, and you know, people were hoping that they had enough momentum to just break through 2,800 because, you know, I mean, it was one of the best rallies in years. But unfortunately for the Fed, that just isn't the case. Now, the Fed also doesn't want to admit that they really only care about stock prices and they don't really watch any other numbers. But yesterday, as it was clear that we were heading down from 2,800, the Fed came out and said, you know what, negative interest rates, QE4, that doesn't sound so bad. We could definitely go along with that, trying to pump the market up by saying, hey, guys, we'll give you free money if you just buy stocks. And not even invoking the magic money tree was enough for stocks to turn green yesterday. Additionally, the administration tried to roll out their regurgitated positive trade talks with China story, which didn't seem to work this time. If you're unfamiliar, during this whole rally, every time that it looked like stocks might go down one day, Trump or somebody from the administration would tweet or say on CNBC that, oh, trade talks are going well with China and we're close to a deal. And, of course, stocks would go up after that. That doesn't seem to be working anymore. The market seems to have figured out that, you see, there's this 2,800 level. We've retested it 4 times, and the market hasn't been able to break through. Perhaps that means that the correct price for the S&P is well below 2,800. Now, the next 2 levels that a CFA I follow on Twitter, Mike Leibowitz, was saying to check for was 2767, which we're going to break down from this morning. It looks like at open, because futures are at 2766. The implied open is something like down 5.5 points or something. So we'll open below 2767, and then the next level after that was 2730. So we're going to want to watch for the Fed's response on that, because again, the stock market has become really just a function of Fed manipulation. The Fed has worked tirelessly since the 2008 financial crisis just to inflate the price of stocks, to make it look like the economy is doing better than it actually is. So by doing so, people won't save as much money, and then they'll go out and buy things, and like, you know, cheap plastic toys or whatever, and that will pump up GDP and make it look like the economy is doing well, when in reality everyone is just spending because there's cheap credit being provided by the Fed. Everyone's gone into debt not to invest in things necessarily, but to consume. That's what the consumers really have been doing. I think that the top 1% has invested quite a bit thanks to the Fed's cheap money policy. Of course, they're about to lose a lot of that because they're being greedy and they don't know when to get out of the market. So the real question to me is that as the Fed keeps pushing their luck and saying that we're going to try and inflate stocks back up again, so until they hit 3,000 and 30,000 on the S&P and Dow respectively, could, considering the pessimism that exists in the stock market right now, would it be possible then for all that inflation that they're trying to inject into the stock markets, if that broke out into the real economy and then we started to see serious price inflation of actual consumer goods? That will be interesting to me, because Of course, I would expect some pretty bad inflation if any of the MMT people get in, but I mean, these are still the relatively conservative economists running the Fed right now. These are not the hyperinflationary butterflies that you see floating around people like Bernie Sanders. But perhaps none of that inflation will really be able to break into the economy because everyone's so over-levered as it is that prices have nowhere to go but down, because you really have people are unable to demand as much in consumption as they have in the past. Because no matter how cheap credit is, I mean, once you're over-leveraged, you can't borrow anymore. It makes it cheaper to borrow as much as you can, but I mean, once you've borrowed all that, you hit a wall. You can't borrow debt forever as an individual. So this means my guess is that the Trump administration is going to try and do some kind of massive stimulus project to do some kind of Keynesian pump priming, because the Fed is tapped out at this point. I think monetary policy has run its course, and they've spent so much time trying to prop up a zombie economy that there's really nothing left that the Fed can do. So sadly, the Keynesians look like will have a renaissance yet again. But frankly, I don't think it'll matter much, because even if the stimulus package, if you remember, after 2008 came after the Fed had already stabilized things. I don't think the Fed is going to be able to stabilize the market at this point. It looks like things are going to go down, and that the Fed really has no ammunition left to try and stop the bleeding. At least back in 2008 when the crisis started, the Fed funds rate was at 5%, and there had not been any QE. So they were able to start QE and lower rates to zero. Now rates are at 2.25, and we've gone through QE 1, 2, and 3 and haven't unwound hardly any of that. So anyway, I can't predict what's coming because it's going to be absolutely nuts. But stay tuned. And while I do follow mostly politics on this channel, I cover relevant market news when it comes around. So stay tuned for that and more, and I'll see you folks tomorrow.